Good day and welcome to our short video explanation of why Robinhood's business model should probably be outlawed in the United States like it is in other countries. We are going to take a Bloomberg interview and we're going to cut it up and explain what some of the terms mean to describe why companies like Robinhood, which have affected the GameStop price and are, part of the Reddit army, have changed the market in a way that is unsafe for investors and in a way that they probably don't understand. This isn't about getting the large hedge funds ahead. This is about stopping people that don't understand what they're doing, who have accidentally made money on the stock market. It's about making sure that they at least understand the risks that they're taking. And right now, I don't think most people do. So let's explain what's wrong with Robinhood.
Their whole business model from the very beginning was to tell the user that something was free, and then to make money somewhere else. That somewhere else in this case is what's known as payment for order flow.
Okay, we're going to interject here. What is payment for order flow? Well, the idea is that instead of buying stocks or bonds directly through the stock market, what you're actually doing is placing an order with another brokerage house who is between you and the company you're dealing with, which in this case is Robinhood, and the stock market. Well, that middleman is going to make a buck. They're paying for your trade information. And how are they doing that? Well, as it says here on Investopedia, the brokerage firm receives a small payment, usually fractions of a penny, on every share sold. And the transactions typically total up to about 50 cents per trade. And you think, well, that's not so bad. I don't mind paying an extra 50 cents on a trade. Okay, let's continue. And you'll see why you really don't want to do this.
And so the practice of payment for order flow is illegal in 4 other developed countries: UK, Canada, India, and Australia, and for a reason. It creates massive, enormous conflicts of interest. And what happens is when you put an order into Robinhood, they don't put it on the exchange, either the NASDAQ or the NYSE. They sell that order to 6 different companies that they work with who are really their customers. That's who pays them revenue. The largest being Citadel, but Virtu, there's several, and all that's disclosed. You can find it on Twitter, on the internet. And those people are even, in addition to kind of maybe, choosing the bid ask they want to fill it at.
Okay, we're going to interject again quickly. The bid ask spread. That's the difference between what somebody will sell the stock for and what somebody's going to buy the stock for. In this case, because you're not dealing directly with the stock market, the middleman that Robinhood uses can effectively set the bid and the ask, making whatever margin they want. And that's your money. Margin is profit. Your profit.
They're allowed to front run the trade in their own account.
When you're buying stocks, you think you're buying it from somebody that wants to sell it. But when you're dealing with companies like Robinhood, who then resell your information to a middleman, that middleman, as he just said, is able to front run it. Front running is a crazy bad idea. That's where the brokerage that you're dealing with, in this case, that middleman that you don't know you're dealing with, but you are, buys the stock that you want to buy at the fair market value, and then immediately resells it to you at a higher price, guaranteeing them margin. Once again, your margin. Once again, your profit. There's no mystery why those companies in the middle will pay for your trade information. You're getting ripped off.
I think it's misleading to the user to say something's free when you're probably those companies aren't paying for that order flow for no reason, right? Why you have to ask, why are they paying for it? Well, they're monetizing it, and that has to do with giving you bad execution or front running your trade, which has the market moving away from you. And you imagine you get a whole bunch of people buying out of the money call options, and then you get the broker that's clearing those trades front running them, and you're going to create massive volatility like we saw. It's now known that 64% of their revenue comes from options trading.
Once again, we'll interject briefly. What is options trading? Well, options trading is buying a contract with someone to buy or sell a stock at some point in the future, but not today. They're very complex, and while we definitely don't think they should be outlawed, as options perform important functions in the market, new investors need to be cautioned because of the risks. They should definitely not be blocked from doing it, but being encouraged to buy options leads more to gambling than investing. And as long as you understand that, that's just fine.
The company wants you to believe and goes on public television and claims that their mission is to democratize investing. And I would say, you know, if this is mostly options trading, that's, you know, there's no book from Warren Buffett or Peter Lynch that says, hey, the way to invest for the long term is to trade options. No one's saying that. They would all dispute that. And so what Robinhood's really doing, I think, is kind of glorifying speculation. They're not democratizing investing. This is one of the most fascinating things that's played out as the internet, you know, intersects with finance. And a lot of people have highlighted or they believe that it's similar to social media's impact on elections and politics, right? And one of the most fascinating things is the groups of people it's brought together. You know, I think AOC and Ted Cruz ended up, you know, rooting for the same player here in this battle between the small investor and the giant hedge funds. You know, what's super interesting is real damage was done.
Real damage was done to the hedge funds. They lost tens of billions of dollars and are changing the way that they're operating. But all of those big hedge funds that were, you know, supposedly the target of the Reddit army, well, they got their money out. You know, they took their losses and moved on. So who really got hurt here? Well, let's take a quick look at the charts. Who bought stock at $200, $300, almost $400? That was rolling back down to $2 or $3. That's already dropped 80 to 90% and is going to go back to the fundamentals, which is known in the industry as reverting to the mean, so getting back to the average. Thousands of little investors, that's who. And that is where the real damage is being done. Those hedge funds can afford to lose some of that money, but I'll bet a lot of those small investors couldn't. Please click like if you liked this video or found it interesting, as it really helps us with the Google algorithms. If you have any questions or concerns, please put them in the comment section below, and we and other people will address them. Also, you can always get a hold of us at www.partisanissues.com. Thanks for your time.